Hello and welcome to the Investing Iguana, where we help you make smart and informed decisions about your money. I'm your host, Iggy, and today we're going to talk about one of the most popular stocks in Singapore, DBS Group Holdings Ltd, or DBS for short. DBS is a leading financial services group in Asia with a presence in 18 markets. It is headquartered and listed in Singapore, and it operates in three key Asian axes of growth: Greater China, Southeast Asia, and South Asia. DBS offers a wide range of banking and financial products and services, such as consumer banking, wealth management, corporate banking, treasury and markets, securities brokerage, asset management, and private banking. DBS is also known for its generous dividend policy, which has attracted many investors over the years. In fact, DBS has been paying dividends consistently since 2009 and has increased its dividend per share from 0.14 SGD in 2009 to 1.02 SGD in 2021. That's an impressive growth rate of 18% per year. But how sustainable is DBS's dividend? How does it compare to its peers? And what are the factors that affect its dividend payout? In this video, we will answer all these questions and more. We will also give you some tips on how to evaluate DBS's dividend performance and prospects. So sit back, relax, and enjoy this complete guide to DBS's dividends. Before we dive into the details, let me give you a quick overview of DBS's dividend history. DBS has been increasing its dividend per share steadily from 2012 to 2019, reaching a peak of 1.5 SGD in 2019. This translates to a dividend yield of 4.58%, which is quite attractive for a blue-chip stock. The payout ratio, which measures the percentage of earnings that are paid out as dividends, was also reasonable at around 50%. However, in 2020, DBS faced some challenges due to the COVID-19 pandemic, which affected its business performance and profitability. As a result, DBS had to cut its dividend per share by 32% to 1.02 SGD in 2020. This was also in line with the guidance from the Monetary Authority of Singapore, MAS, which asked local banks to cap their dividends at 60% of their previous year's level. Despite the dividend cut, DBS still managed to maintain a decent dividend yield of 3.11% in 2020, which was higher than the average yield of the Straits Times Index, STI, at 2.8%. The payout ratio also remained prudent at around 50%. In 2021, DBS resumed its dividend growth by increasing its dividend per share by 40% to 1.44 SGD. This was based on a quarterly dividend of 0.36 SGD for each quarter of 2021. The dividend yield improved to 4.4%, while the payout ratio stayed at around 50%. In addition, DBS announced a special dividend of 0.5 SGD per share for the first quarter of 2022, which will be paid together with the regular quarterly dividend of 0.42 SGD per share on April 21, 2022. This means that DBS shareholders will receive a total dividend of 0.92 SGD per share for Q1 2022, which is equivalent to an annualized yield of about 11% based on the current share price. The special dividend was declared to reward shareholders for their loyalty and support during the challenging times of the pandemic. It was also made possible by the strong financial performance and capital position of DBS in 2021. So how did DBS achieve such impressive results in 2021? And what are the prospects for its future growth and dividends? Let's take a closer look at some of the key factors that affect DBS's dividend policy. Factor number 1, earnings growth. One of the most important factors that determine a company's ability to pay dividends is its earnings growth. After all, dividends are paid out of earnings, so if a company can grow its earnings consistently over time, it can also afford to increase its dividends accordingly. DBS has demonstrated a solid track record of earnings growth over the past decade. Its net profit increased from $2.8 billion in 2010 to $6 billion in 2020, representing a compound annual growth rate, CAGR, of 8%. In 2021, DBS achieved a record net profit of $7.2 billion, which was 32% higher than the previous year. This was driven by strong growth in its core businesses, such as consumer banking, wealth management, and institutional banking. DBS also benefited from the economic recovery in its key markets, especially in China and Singapore, which helped to boost its loan and fee income. Moreover, DBS managed to reduce its credit costs significantly in 2021, as it released some of the provisions that it had set aside for potential loan losses due to the pandemic. Looking ahead, DBS expects to sustain its earnings momentum in 2022 and beyond, as it continues to leverage its digital capabilities and regional presence to capture new opportunities and serve its customers better. DBS also aims to diversify its income sources by expanding into new areas, such as sustainable finance, digital assets, and insurance. Based on analysts' estimates, DBS is projected to grow its net profit by 9% in 2022 and 7% in 2023. This implies a forward earnings per share (EPS) of 3.06 SGD for 2022 and 3.28 SGD for 2023. Factor number 2, capital adequacy. Another key factor that influences a company's dividend policy is its capital adequacy. This refers to the amount of capital that a company has to support its operations and absorb potential losses. Capital adequacy is especially important for banks, as they are subject to strict regulatory requirements and need to maintain sufficient capital buffers to ensure their financial stability and resilience. DBS has a robust capital position that exceeds the regulatory standards and industry benchmarks. As of December 31, 2021, DBS had a Common Equity Tier 1 (CET1) capital ratio of 15%, a Tier 1 capital ratio of 16.5%, and a total capital ratio of 19.4%. These ratios measure the quality and quantity of DBS's capital relative to its risk-weighted assets, RWA, which reflect the level of risk that DBS faces from its lending and investment activities. The minimum regulatory requirements for these ratios are 6.5%, 8%, and 10% respectively, while the average ratios for the top 100 banks globally are around 14%, 15%, and 18% respectively. This means that DBS has ample capital headroom to support its business growth and withstand any adverse shocks. In fact, DBS has one of the highest capital ratios among its peers in Singapore and Asia. For comparison, the CET1 capital ratios of OCBC and UOB as of December 31, 2021 were 14.9% and 14.6% respectively. DBS's strong capital position also gives it the flexibility to pay higher dividends to its shareholders, as it does not need to retain as much capital for regulatory or growth purposes. This is why DBS was able to declare a special dividend of 0.5 SGD per share for Q1 2022, which will bring its total dividend payout ratio for 2021 to around 70%. However, DBS has indicated that the special dividend is a one-off event and not a change in its dividend policy. DBS's dividend policy is to pay out between 40% to 60% of its earnings as dividends, depending on its earnings outlook and capital needs. This policy is consistent with the guidance from MAS, which expects local banks to adopt a prudent and sustainable dividend policy that balances their capital preservation and shareholder returns. Therefore, investors should not expect DBS to pay such high dividends on a regular basis unless it can generate significantly higher earnings or reduce its RWA substantially in the future. Factor number 3, dividend sustainability. The final factor that we will look at is the dividend sustainability of DBS. This refers to the ability of DBS to maintain or increase its dividends over time without compromising its financial health or growth potential. To assess the dividend sustainability of DBS, we can use some metrics such as the dividend payout ratio, the dividend cover, and the free cash flow yield. The dividend payout ratio measures the percentage of earnings that are paid out as dividends. As mentioned earlier, DBS's dividend payout ratio has been around 50% for most of the past decade, except for 2020 when it was capped at 60% by MAS and 2021 when it was boosted to 70% by the special dividend. A dividend payout ratio of 50% is considered moderate and reasonable, as it allows DBS to retain half of its earnings for reinvestment and growth, while rewarding its shareholders with the other half. The dividend cover measures the number of times that the earnings can cover the dividends. It is calculated by dividing the EPS by the dividend per share. A higher dividend cover means that the dividends are more secure and sustainable, as there is a larger margin of safety in case of a drop in earnings. DBS's dividend cover has been above 2 for most of the past decade, except for 2020 when it was 1.67 and 2021 when it was 1.43. A dividend cover of 2 means that DBS can pay its dividends twice over with its earnings, which is considered healthy and comfortable. A dividend cover of 1.67 or 1.43 is still acceptable, but it indicates that DBS has less room to increase its dividends further without increasing its earnings or reducing its payout ratio. The free cash flow yield measures the percentage of free cash flow that is paid out as dividends. Free cash flow is the cash that a company generates from its operations after deducting its capital expenditures. It represents the cash that a company has available to pay dividends, repay debt, or invest in new opportunities. DBS's free cash flow yield has been positive and above 3% for most of the past decade, except for 2019 when it was negative and 2020 when it was 2.6%. A positive free cash flow yield means that DBS can pay its dividends with its cash flow without relying on external financing or depleting its cash reserves. A free cash flow yield of 3% or higher means that DBS can pay its dividends comfortably with its cash flow without compromising its liquidity or solvency. Based on these metrics, we can conclude that DBS's dividends are generally sustainable and well supported by its earnings and cash flow. However, DBS's dividends are also subject to some risks and uncertainties, such as a. The impact of the COVID-19 pandemic and its variants on the global and regional economy and financial markets, which may affect DBS's business performance and profitability. b. The regulatory environment and policies of MAS and other authorities, which may impose restrictions or requirements on DBS's capital management and dividend distribution. c. The competitive landscape and technological disruption in the banking and financial services industry, which may affect DBS's market share and growth prospects. And d. The interest rate environment and currency fluctuations, which may affect DBS's net interest margin and foreign exchange exposure. Therefore, investors should monitor these factors closely and adjust their expectations accordingly. To sum up, DBS is a leading financial services group in Asia with a strong track record of earnings growth and dividend payments. DBS has a robust capital position that exceeds the regulatory standards and industry benchmarks. DBS has resumed its dividend growth in 2021 after a temporary cut in 2020 due to the COVID-19 pandemic. DBS has also declared a special dividend of 0.5 SGD per share for Q1 2022 to reward its shareholders for their loyalty and support. DBS's dividends are generally sustainable and well supported by its earnings and cash flow. However, DBS's dividends are also subject to some risks and uncertainties, such as the impact of the pandemic, the regulatory environment, the competitive landscape, and the interest rate environment. Therefore, investors who are interested in DBS should do their own due diligence and analysis before investing in this stock. They should also diversify their portfolio with other stocks that offer different risk-return profiles and growth potential. That's a wrap for today's episode of the Investing Iguana, where we strive to help Singapore-based finance, investment, and wealth enthusiasts stay informed and ahead of the curve. We hope you found today's content insightful and valuable in your journey to financial success. If so, please show your support by giving this video a thumbs up and subscribing to our channel for more expert advice, market analysis, and financial tips tailored to Singapore's unique landscape. To ensure you never miss out on our latest content, hit the bell icon and enable notifications for all future uploads. We're eager to engage with our audience, so please don't hesitate to leave any questions, comments, or feedback in the comment section below. Our team will do its best to respond promptly and address your concerns. Additionally, we're always on the lookout for fresh ideas and relevant topics to cover in our upcoming videos. If there's a specific subject related to Singapore's finance, investment, or wealth management sectors that you'd like us to explore, please share your suggestions with us. Thank you for tuning in to the Investing Iguana. We're dedicated to empowering you with the knowledge and tools necessary to thrive in Singapore's dynamic financial environment. Until next time, happy investing.